Hey, this is Brett with the Complete Trader. Just wanted to come to you with a short little video on option straddles. This is a excellent technique to take advantage of volatile markets, markets that honestly you don't know which way they're going from one day to the next, 1 week to the next, and as of right now, May 14th, that's the market that we're in. It is a very, very fluctuating market. And unfortunately, it's a market where if you're doing naked calls, naked puts, unfortunately, good chance of it leaving your brokerage account naked before too long without any money in it. So so a strategy like a option straddle, I like to call it the volatility straddle, is something to really, really consider if you want to protect yourself during these highly volatile times. Now, just to get into the basics of it, we're looking here at the SPY, the ETF of the S&P 500, and we're after the close on a Thursday, and Thursday at the close, or just before the close, is a great time to put in these or implement these volatility straddles. Now, why is that? Well, a few things to take into consideration. Expiration is the next day. So contracts are quite cheap. As we can see here, where I have the option chain pulled up, our expiration is tomorrow, and this is what our contracts are at. $186, $127, $96 for our call contracts. Of course, very close on the opposite side. They almost mirror each other on the put side. Now, what's very interesting is combining a volatility straddle along with an option that's about to expire the next day is a very, or the same day, is a very, very powerful method to take advantage of. So just want to explain it here. So this is what makes it so powerful. Because take granted, if you can do a straddle, a long-term straddle, short-term straddle, but the problem is that stock has to move a substantial amount to be able to get in the money. Because again, the basics of a straddle is you're straddling both sides. You got a call option, and then you have a put option. That's it. You have one on both sides. That's a straddle. Okay, so in this situation, the equal straddle right here would be right here at 285 would be 186 contract, 187 contract. All right. Now, of course, the contracts, the first thing you want to look at. The next most important thing for a volatility straddle to look at is our delta. We see our delta right here. Now, 51 cents. Now, of course, we know we're dealing with options, controlling 100 shares of a stock, so it's multiples of 100. So everything's multiplied by 100. So this 51 cents times 100 is $51. Okay, in the same way with this $1.86. The contract doesn't cost $1.86. It's $186. These are always multiplied by 100 when you're dealing with stock options. Okay, so always want to keep that in mind. So, the volatility straddle. How are we taking advantage of it at expiration? Well, if we look here, our delta, $51, $186. So a delta, very simple. For every dollar the stock goes up, I will make $51, according to this delta where it's at right now. Okay. As the stock price goes up, of course, the delta increases. Okay. Gets higher and higher and higher. In the same way, if I buy a put and the stock goes down, my delta will increase. But at the same time, if I buy this put and the stock goes down, my delta decreases until it gets to 0. Okay, same thing for the call side. So deltas are very important for a stock option trader. The delta is the #1 Greek. These are all Greeks. The delta, gamma, theta, vega. These are all Greeks. But delta is king of the Greeks for an option trader. Okay. Now, so when we put in our volatility straddle, again, the two things we're looking at stock price and we're looking at the delta. Okay. So right here, we see that the delta is $51. So if we divide this stock price, we take the stock price 186 divided by 51, we're going to get 3.2. So that means that this stock needs to move at least $3 if we're going to make money. Because again, what we're going to do on this straddle is we would buy this call. Okay, let that pull up there. And then we're going to buy the opposite equal put. We would buy this put right here. $187, $186, 51 delta, 48 delta. Now, deltas aren't exact, but as long as they're close, that's what we're looking for. Within a $5 to $8 difference on the delta. As long as we can get that nice and tight, we're good. Okay, so the simplicity of it is this. We buy both of these options. Okay? You might think, well, how are you going to make money? I mean, you would make the same amount. Whatever you make here, you would lose here. Or the other side, whatever you make, stock goes down on the put side, whatever you make here, you just lose here. That's true. Until you get past the $3 point, the $2 to $3 point. Once this S&P, this SPY, once it moves more than $2 to $3, you start making money after that. Okay? It's very simple. It keeps us from having to guess direction, to put in risky spreads or condors or all the different. This is extremely low risk here. All right? Because again, we're just banking on volatility in the market. These will cancel each other out. The call and this put will cancel each other out until this stock either goes up more than $2 to $3 or goes down more than $2 to $3. Once that happens, you're in the profit. Until then, you're pretty much break even. So, worst case scenario, you're right around break even. You may lose a little, gain a little bit. If it stays within that less than that $2 to $3 range, say it only moves $1, well, you close them both out, live to fight another day. But with this market, the way things are moving, the volatility of it, the fact that we're holding this overnight until the next morning, the chances of us getting at least a $2 to $3 move in this market, very, very likely. So that's what makes this so powerful. It's very low risk, very low risk. You're going to be hard pressed to find lower risk on any option strategy than this. If you know of one, please let me know it. I don't know of anything that you're going to find lower stress or lower. Well, it's low stress as well, because there's nothing more stressful than having a naked option and it turns on you. But yes, very low risk. Again, all you need for profit is at least a 2 to 3 point move. Very, very simple. Okay. So as you can see here, we got some more. As you get further away from in the money, because again, in the money is right here. The stock price is right at 285. So right here, we're right at the money. Right at it. Now, the further you get away from at the money, the more riskier these straddles get. And the less time you can hold them. Because again, your theta, if you're holding these for an extended period of time, the theta will get you, especially if you're out of the money. Now, if you're in the money, hey, honestly, you don't have to worry about theta because this contract's going to expire. And say you have this contract. This is, say potentially this is pretend like this was today, and you bought this one right here. All right, then you were in the money. When the day's over, you're in the money. Doesn't matter. Doesn't matter what the theta was, your time decay. At the end of the day, you were in the money, so nothing to worry about. Okay, so, but again, once you start going out of the money, getting further out of the money, or on the put side, further out of the money, and you get closer to expiration, which tomorrow would be Friday, closer to the end of the day, the more the theta will start decaying this option, because the likelihood of it getting to that number is very low the closer we get to expiration. So it's always safer the closer you can get to the strike, the better. Now, for the way the market's moving, a 2 to 3 point move per day or dollar move per day has been easy. So for me, I've had no issues whatsoever coming $1 out, $2 out, and some I even go $3 out. Because again, the stock's moving that much. But for safety purposes, yeah, it's definitely safer to come in here and get nice and tight to this stock price. Okay? But some options are, like I said, it takes going out $1 or $2 to get a nice delta that when multiplied by 2 or 3 is pretty equal to the stock price here. Again, we want to ideally look for stocks on the expiration day or the day before expiration that, again, the stock has to move $2 to $3 for it to equal the stock price. So again, this stock right here, this would have to move $3, a little less than $3 to equal this contract price. Okay? But again, as the stock starts going higher and higher, this delta will increase. It will go from $33 to $42 to $51. So the higher it goes, the more your delta increases, and then the more your delta decreases on the other side. So I hope that's easy to understand there. At the end of the day, it's very basic. We're looking for contracts that are very cheap, the day to buy just before expiration the day before, within the last hour or so, or the morning of expiration. That's what we're looking for. Okay, and we want to, again, looking for deltas that when multiplied by 2 or 3 equal right around our contract price, meaning they will only have to move $2 to $3. After $2 or $3 of movement in the stock one way or the other, we're making money. Simple as that. Now, let's look at another stock here. Let's look at BOA. See what it looks like. All right, so we've got BA pulled up here. Okay. Now, unfortunately, BA is, it's going to be 4. The stock's going to need to move $3 or $4 for us to start making money. So we'll see here $30 and then $114. So 3, 6, 9, 12. All right, so unfortunately, it's going to have to move a little over $3 at this point to get in the money. But again, keep in mind, as the stock increases on this call side, the delta will increase as well. So we got that in our favor. And at the same time, on the put side, the delta will increase as the stock goes down. So, with that said, in this situation, what would we choose? Now again, 44, 198, so a little bit more than 4 times to get to equal this contract price. Now, in this situation, what I've done, because delta moves so much, is I actually went out and bought all the way out to the 125 strike. So a couple dollars away. Okay, because this one is only, this is only 3 or 4, a little less than 4, and this one's a little bit more than 4 times to get to this contract price. So, good thing about that is the way Boeing moves in a day. Yeah, it's very, very normal to get 5 to 8 point swings or $5 to $8 swings in Boeing. The one I did last Thursday, bought it right before close, bought a call and a put, and it ended up, my call side ended up, the stock went up $3 to $4 or $4 to $5, and the call side ended up making $341, and then the put side ended up being a negative 127. So still oh no, I apologize. No, the call side ended up going to 420, 430, somewhere in there, and then the put side was a negative 120. So yeah, it was a profit of 300 plus dollars, somewhere around there. So anyway, it's a prime example of how beautifully the volatility straddle works. So just to now, take for you come down a little bit further. I mean, you can even, with a stock that moves like Boeing, you can even come out $3 or $4 away. And then when you come out further, as you see here, your delta and your contracts get even closer. All right, so as far as the multiples, you get closer to 3 than you do 4 times to equal that same contract. So, but just to give you an idea here, let's say you came out to this 65. Now the equal on the other side would be right here, $32. Now, in this situation, what would you do? Because again, we want to have as close to equal contract prices on both sides, as well as equal deltas. But as you see here, that's not the case. 65 and 32. So what can you do in this situation? Well, simple addition. We're going to double this. So we would buy 2 of these contracts. All right, so that would make this 64, and this is 65. So we're good there. Always we're within $5 to $8 or $5 to $10, we're good. And then our delta 18, what's our delta over here? Okay, it's 11. Well, that would get doubled as well. It'd be 22. So 22 and 18, still very close. So that's how you would do it in a situation like that. When you don't have exactly matching contracts, you simply buy, like I said, 1, 2, 3, 4. 1, 2, 3, 4. Okay. You just double the contracts, and you're set. That'll give you very similar contract prices and very similar deltas. So, hope that makes it a little bit easier to understand. I definitely recommend paper trading this. See how it works. Look at the benefits. Now the days that you can do this volatility straddle on, now when you're trading the SPY, remember you have 3 expirations per week, Monday, Wednesday, Friday. So that means that Tuesday before close, you can put this on. Wednesday morning, the day of expiration, you can take advantage of this. And then also too on Thursday, like today, before close, you can put these straddles on. And then Friday morning, you can put them on as well to take advantage of that early morning swing that you get. A lot of that early morning swing you get in the stock. And then also too, you can put it on again for the SPY Friday before close, because you got an expiration on Monday. So SPY is an excellent stock to do the straddle on. You have, with 3 expirations, you have 3 days per week that you can take advantage of this volatility straddle. Whereas with your weekly stocks like Boeing, well, you can only really safely take advantage of this method Thursday before close and then Friday morning. But sometimes with BA, I actually did volatility straddles in the morning on Thursday. So if the contracts line up and you feel confident that the stock can move, at least $3 to $4, then hey, you can take advantage of it even earlier in the day on a Thursday, rather than just taking advantage on it Thursday before the close. So hope that makes it a little bit easier to understand. Again, it's a very simple, basic technique, and what makes it beautiful is, very low risk. Your chances of the only way that you could really mess up this volatility straddle, is if you came down here and you bought $2 to $3 out of the money, and the stock only moved, say, $1 to $2, and you held it all day and you let it expire. In that case, yes, you can lose. You can lose the value. You can lose the value on both sides, because you wouldn't get in the money on either side. So you could lose the total contract's price on both sides. But again, if you're not doing that, if you're buying the option in the hour or two before close on Thursday, and what's nice is if you buy it an hour or two before the close, if you get a nice volatility in the last hour, you can close it out, make a profit. I've done this numerous times. You can close it out, make a profit before close on a Thursday, and just buy another straddle to have for overnight, catch that volatility, and the next morning. So yeah, it's a nice way to double dip for sure. But again, as long as you're not holding these contracts for an extended period of time on the day of close, again, especially these ones whenever you come $2 to $3 out of the money, the further you get away from this strike price right here, what the stock's at, the further you get away from that, the less you want to hold these. You don't want to be holding these. You're out here, you don't want to be holding this more than 2 to 3 hours after the open on Friday. Okay? Don't want to do that. So once you get in the profit, just be content with your profit, especially if you're not getting a lot of movement of the stock, but not a lot of volatility. Just take your profit, or just take your break even, or right up close to break even, and get out of there, and look forward to the next opportunity to take advantage of it on the next Thursday for the weeklies. So again, great method. Now you're wondering, well, I can only make so much money. Stock can only move so much. That's true. You want to make more money on this method, this volatility straddle? It's very simple. You just buy more contracts. So instead of just buying one of these and one of these, or rather one of these, the 206 and the 198, so Got an $8 difference there. Nothing wrong with that. Is you would just buy 2 of these and 2 of these. Very, very simple. Now you double your profit. So I'll buy 2 of those and I'll buy 2 of those. Or I'll buy 3 of those and 3 of those. Or 10 of those and 10 of those. However many you want. Ultimately, the more you buy, the more equal contracts you buy, the greater your profit will be. So, very simple. Hope that gives you a little bit better understanding of the volatility straddle and how to take advantage of it. And again, in this market, I highly, highly recommend using this method to your advantage. Because again, we don't know what we're going to get from one day to the next. So again, there's a lot of stocks that you can take advantage of this with. Really, once you start getting past the 3 to 350 stock price, yeah, you start getting out of the range of stocks that this works for. When you factor in your delta and the cost of the stock price, so usually about 350 and lower is the stocks that you want to be looking for to implement this short-term volatility straddle on. So I hope that helps everyone. Yeah, just thank you for watching this video. A little bit longer than I wanted, but I just wanted to be as thorough as I could to ultimately try to help y'all make as much money as you can in this very volatile market. So again, this is Brett with The Complete Trader, and you have a great rest of your night.